Good day, everyone. You're welcome to this week's Business and Investment Tips Program, a production of RCCG Christ Church Radio with Ayodeji Ebo, an investment professional. This week, the focus is on the implications of the CBN's interest rate hike. The Central Bank of Nigeria's CBN highest policy-making committee, the Monetary Policy Committee (MPC), held its second meeting of the year last week, 20th and 21st March 2023, to discuss key global and domestic developments since the last meeting in January 2023. The MPC is composed of a 12-man committee, including the CBN governor. The MPC meeting holds bi-monthly with 4 more expected meetings this year. Surprisingly, all but one member of the MPC voted to raise the monetary policy rate (MPR) for the 6th consecutive time since May 2023. Explicitly, 10 members voted to increase the MPR by 0.5%. One member voted for a 0.25% increase and another voted to hold the MPR at its current level. Overall, the MPR was raised by 0.5% to 18%, while the other policy parameters were retained. The asymmetric corridors remained at plus 100 basis points minus 700 basis points around the MPR, the cash reserve ratio (CRR) at 32.5% and the liquidity ratio at 30%. The MPR is the interest rate at which the CBN lends to the commercial banks. The MPR is the benchmark against which other lending rates in the economy are pegged. It is also used as an instrument to control inflation in the economy, though the MPR has been ineffective in the recent years due to more prominent use of OMO securities. The rate has recently regained influence in signaling CBN's intentions. Cash reserve ratio is the minimum amount banks are expected to retain with the CBN from customer deposits. This implies that out of every 1,000 naira deposit collected by the banks, 325 naira is expected to be with the CBN. Effectively, the banks can only transact business and earn income with only 675 naira out of 1,000 naira. To understand more about our other key rates, kindly listen to our previous broadcasts on this topic. What are the implications of rate hike? 1. Rise in interest rates and savings accounts. Higher interest rates can encourage people to save more as they can earn a higher return on their savings, given that the minimum savings rate now comes at 5.4%. However, this is subject to the other conditions which may vary across banks, like limits to the number of withdrawals per month to qualify for interest. Increased savings can also be beneficial to the economy in the long run, as it can increase the amount of money available for investments, which can help boost economic growth. 2. Higher rates, lower yields. While an increase in the MPR can make fixed income securities more enticing to investors, following a repricing of these assets, yields appear to be heading in the opposite direction. The most recent T-bills primary market auction, where the average stop rates dropped from 5.81% at the last auction to 5.68%, further buttresses this point. This suggests that the yields in the fixed income market are less sensitive to the MPR and more responsive to the level of liquidity in the financial system. Ultimately, we believe that the CBN is taking advantage of the high levels of liquidity in the system to lower borrowing costs. 3. High borrowing costs. Following the 5 rate hikes witnessed since 2022, borrowing cost has also registered a steady uptick. So far, the prime and maximum lending rates has increased from 11.96% to 27.37% in May 2022 to 13.67% and 27.63% in January 2023. Hence, a further jump in the MPR will result in an increase in the cost of borrowing for businesses and individuals, particularly loans that are floating or variable rates based. However, the impact of high interest rates goes beyond just the cost of borrowing. The risk of loan defaults and impairments are also at a rise. All borrowers struggle to keep up with the increased payments. This in turn can dampen the profitability of banks and other lenders. This may, however, be offset by increased interest income on loans. 4. Foreign investments remain unmoved. Despite the potential benefits of higher interest rates in attracting foreign investors seeking better returns, Nigeria's current economic conditions has deterred such investments. The country's multiple FX windows, coupled with a dollar shortage and unattractive yield environment, has made it less appealing to foreign investors. Consequently, until policymakers take bold steps to address the multiple FX rates and adjust the currency to reflect its true value, foreign investments are likely to remain limited. 5. Inflationary pressures persist. Despite the CBN's effort to control inflation through tight monetary policies, including the most recent being the mop-up of the currency in circulation to lower demand through the Naira redesign, inflationary pressures have persisted. It appears that there are many other factors like supply chain challenges at play beyond the consumer demand that is driving Nigeria's inflation. We expect that inflationary pressures would persist owing to an anticipated removal of fuel subsidies, further Naira depreciation, and other existential challenges. 6. Muted reaction to the rate hike. The continuous rate hike will have a minimal effect on equities, given that yields in the fixed income space is not reflective of the rise in the MPR. Hence, investors will seek out avenues to earn positive real returns on their investments, avenues like the stock market, which can deliver positive real returns. However, it is important to note that the stock market is risky, meaning that your returns are not guaranteed. Hence, we advise you to maintain caution when buying stocks. You can consider positioning for undervalued stocks with attractive dividend yields. The next MPC meeting of the year will hold on the 22nd and 23rd of May, where we believe the MPC may soften the pace of its rate hike to 0.25% or at least adopt the wait-and-see approach. However, in our view, we do not expect that this will have any significant impact on inflation or fixed income yields. Thank you for listening. Please join us same time next week for another exciting and insightful session. For questions, comments, and feedback, kindly forward to ebo.ayodeji@gmail.com or send an SMS to 070-8246-3747. Stay blessed.